Hey there, financial navigators. Welcome back to the channel where we decode complex market signals to give you actionable insights. Today, we're diving deep into a specific stock that has popped up on our hard-to-borrow screener, ILLR Group Inc., trading under the ticker ILLR. We're going to break down why its cost-to-borrow fees are skyrocketing and what that could mean in the world of short squeezes. This isn't just theory, we're looking at real numbers for a real company right now. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show logo/chart for ILLR. Let's start with the basics on ILLR Group Inc. This company operates an artificial intelligence-powered technology platform across Hong Kong, the United States, and internationally. Their flagship product is the ILLR app, a video sharing platform, but they also provide AI-powered customer engagement, cross-platform marketing, and social messaging solutions. It's a technology/software application play with a current market cap of just $41.06 million, placing it firmly in micro-cap territory. Looking at recent price action, ILLR saw an impressive plus 11.37% gain today, but has actually pulled back minus 13.28% over the last 5 trading days. Over the past month, it's up a modest plus 0.86%. Volume today was 1,169,074 shares, which is quite low compared to its 30-day average volume of 11,553,651 shares, giving it a relative volume of just 0.1x. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When a stock is hard to borrow, it refers to the difficulty short sellers face in finding shares to sell short. This scarcity drives up what's known as the cost to borrow, or CTB fee. Think of it like a rental fee. Short sellers borrow shares from non-investors, sell them, hoping to buy them back cheaper later. The CTB is the annualized interest rate they pay for that privilege. When this fee gets extremely high, it signals intense demand from short sellers coupled with a very limited supply of available shares. Unlike traditional loans, these fees can easily exceed 100% annually because the supply-demand dynamic is so extreme. A high CTB indicates significant short interest and a shrinking pool of available shares, creating potential pressure points for short sellers. Why this stock is hard to borrow right now. Highlight CTB numbers on screen. Now, let's look at why ILLR Group Inc. has landed on our hard-to-borrow radar. The current annualized cost-to-borrow fee for ILLR is an astounding 745.0%. That's not a typo, 745%. Even more compelling, this CTB has seen massive momentum, soaring by plus 733 percentage points over just the last 5 trading days. This kind of rapid increase suggests a sudden and dramatic tightening of borrowable shares. Currently, there are only about 100,000 shares available to borrow, against an estimated float of 17.9 million shares. Our internal composite squeeze score for ILLR, which combines CTB level, momentum, borrow supply, float size, volume, and technical setup, currently sits at a notable 65.3 out of 100. Squeeze mechanics explained. Animate short squeeze concept. So, how does this all translate into the potential for a short squeeze? A short squeeze happens when a stock's price suddenly jumps, forcing short sellers to buy back shares to limit their losses. This buying action further pushes up the price, creating a domino effect. When a stock like ILLR has a high cost to borrow, it puts immense financial pressure on short sellers daily. Every day they stay short, they pay that exorbitant fee. Combine that with the shrinking supply of available shares, and new short positions become difficult, if not impossible, to initiate. If buying pressure starts to build, these short sellers, already burdened by high fees, might be forced to cover their positions, leading to a rapid price ascent. The relatively small float of 17.9 million shares also means that any significant buying pressure can have an outsized impact on the share price. Dilution risk check. An important factor to consider with any potential squeeze candidate is dilution risk. Dilution refers to the issuance of new shares, which increases the total number of shares outstanding and can depress share price. A stock with high CTB could see its short squeeze thesis completely negated if the company suddenly announces a dilutive offering. For ILLR Group Inc., ILLR, our checks indicate no recent diluted SEC filings such as -1, -3, or 424B found in the last 90 days. This is a positive sign for the short squeeze narrative, as it means fewer new shares are likely to hit the market and absorb buying pressure from short covering. Recent reverse split watch. Show chartless split annotation. Another critical piece of the puzzle for ILLR is its recent reverse stock split. Triller Group Inc. executed a 1/4-10 reverse stock split on June 23, 2026, which was just 14 days ago. A reverse split reduces the number of outstanding shares and proportionately increases the share price. While it might sound neutral, for microcap stocks this often reduces the readily available float and resets the share price higher, potentially making it more attractive to certain types of investors. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. Now, this is a pattern we've observed, not a guarantee, but it's certainly something to keep in mind for ILLR's trajectory. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with all this information, what should you be watching for with ILLR? Remember, a high cost to borrow does not guarantee a short squeeze. It can also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. For ILLR, keep an eye on a few key indicators. First, continued high or increasing CTB fees, and further shrinking of those 100,000 available shares to borrow. Second, watch for any significant increase in volume, especially relative to its current lower average, coupled with strong price momentum breaking through technical resistance levels. Lastly, given the recent reverse split, pay attention to how the market reacts within the upcoming weeks, as historical patterns suggest this could be a period of increased volatility for ILLR. Joanne Slate with CTA. Triller Group Inc. ILLR presents a very interesting case study with its astronomical 745.0% cost to borrow, rapidly decreasing share availability, and recent reverse split. It's a dynamic situation that highlights the mechanics of hard-to-borrow stocks and the potential for a short squeeze. Always conduct your own thorough due diligence. If you found this breakdown valuable, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments if you're watching ILLR or have any questions about short squeezes. We'll see you in the next video.